Hello. In today's lecture, we're going to go over a basic exercise in which we will do three of the steps of the accounting cycle. We will read the transactions and enter them into the general journal. This step is called recording in the general journal. Next, we transfer the information into the ledger. That's called posting into the ledger. And at the end of the period, we will prepare our trial balance. So in the accounting cycle, the first four steps are analyzing the transaction. Second is recording in the general journal. Third is posting into the ledger. And the fourth is preparing the trial balance. So in this exercise, we have to do steps 2, 3, and 4, but we have to do step 1 in order to do step 2. So with that, let's get started with our exercise. We have Riverhawk Expeditions that provides guided tours in scenic mountainous areas. After the first 11 months of operations in 2021, Riverhawk has the following account balances. So January 1st through November 30th, they've done their business and we have these account balances. So now for the next month, before we get started, we have all of these account balances. So let me show you what I have over here. I'll have my general journal, but I'm not yet ready to start with that. So let me hide these columns for a second. I have all my accounts. I've written down the accounts. And instead of doing T accounts, which is a way in which you can present the information, we have it as it would be in the ledger. As I do that, I will explain it. I'll just start with one of them. We have the cash account. That's the first account name that I see over here. I have a column that's listed number, and in a few minutes, you'll know what that is for. The next column is date. Then we have a column for debit, credit, and the balance. Now, as you go along, you will know what the balance should be, the normal balance for each of these accounts. Now, the trial balance tells me that cash has a 9,200 debit balance. Here I'm writing balance, but I know it's a debit balance because it's an asset. I've done the same for all the other accounts. I brought the information from November 30th into these accounts. Now that I have that information taken care of, let me go back to the general journal that I'll need to work on. Now for that, I have the transactions. They've given me a list of transactions that have happened. I have to read through these transactions, the information presented. I first analyze it and decide, is it an accounting event that needs to be recorded in the journal? Or maybe it's just information that's been given relevant to the business, but not a journal but something that does not merit a journal entry. So we've been asked to record each transaction, post it into the relevant T accounts. We have ledgers set up instead of T accounts, they're essentially the same. Calculate the balance at the end of each month. And they've told us, make sure you have the beginning balance. I already have that in place. And finally, prepare the trial balance. So I'm going to slide this up a little so we can see this information. So let's start out over here. On December 1st, I paid rent for the mountain lodges for the month of December, $900. So I'll start out by writing the number 1 over here to indicate it's transaction number 1. Typically, a business would not have a column and they would not identify transaction numbers, but we are doing this for this particular textbook. This is how it's set up. The date, I obviously write my date, which is December 1st. Now, account cash. I paid cash, so cash decreases, so cash has to be credited. And if you recall cash, all credits are always written second. You first write the debits and then the credits. So I'm crediting cash for $900 and I'm going to debit rent expense. I paid for rent. So rent expense debit, rent expense is a cost of doing business. All expenses are cost of doing business. So I paid rent, so rent expense debit, cash credit. Now, I have one of two ways in which I can do the posting, real-time posting or batch posting. In real-time posting, as soon as a journal entry is done, we post it into the relevant accounts. I'll do batch posting, which means I'll do it at the end of the month as a batch. They'll all be done at the same time. Okay, so moving on to December 5th, the second transaction. I provide guided tour to customers in the Grand Teton National Park. and this is a cash transaction, and I earned $2,800. My customers paid me $2,800. So I will write the date over here, the transaction number first. Then I will write the date of the transaction. I earned cash, I received cash. Cash balance goes up, cash is an asset. In order to increase it, I'm going to debit the account. This $2,800 is mine to keep because I earned it. And the money that I earn from my customers and clients, I call it service revenue. So cash debit, cash is an asset, service revenue is a revenue item, which is basically part of the stockholders' equity. It's going to affect your retained earnings eventually, but we'll not worry about that for now. Let's look at now the third transaction, December 8th. I borrow money from a local bank by signing a note payable, $10,000. The note is due in 1 year with a 6% interest. So right now what I'm looking at is I borrowed $10,000. I have to repay it at the end of 1 year, which means it'll be December 8th of 2022 that I'll have to pay it. And at that time, I'll also have to pay 6% interest. So let me take care of the money that I borrowed right now. First, I write my date. Cash came into the business, so cash is debited. It's $10,000. Now this $10,000, unlike the previous transaction, here when I received the cash, it was mine to keep. This cash, I borrowed it, I will have to return it. So in my books, I'm going to credit notes payable. It's a liability. When you see the word payable, it's a liability. Liabilities are always credited when we create the liability. To increase it, we credited the account. Let's look at the next transaction. On the 12th, I received cash from a customer as payment for a guided tour that occurred on November 28th. That's 3,500. Okay, so let's see what happened over here. On December 12th, I received cash. I got this 3,500. Now, when I received cash in transaction number 2, I called it revenues. I got it from a customer. Here too, I received cash from a customer, but this is for services that was already performed in the previous month. So in November, when I performed the services, I already credited service revenue. If I credit service revenue again over here, I'll be double counting the revenue. So what should I credit over here? So let's go back. In November, when I earned the revenues, what did I debit? I didn't debit cash because I didn't get cash at that time. What I had debited was accounts receivable. I created an asset in my books, accounts receivable, saying I will receive money from the customer. It's an asset. Receivable is an asset. Here I told you, payable means it's a liability. When you see the word receivable, it's an asset. Now this asset is decreasing because I got cash. So in this case, I'm trading one asset for another asset. Do not credit service revenue now, because if you do, you'll be double counting revenues. Okay, let's move on to number 5. On December 13th, I issued additional shares of common stock for cash. So obviously I needed more money. Here I borrowed 10,000, now I want even more money. So I decided to go to my shareholders and ask them for more money, either the existing shareholders or new shareholders. They gave me money, so I debit cash, and the amount I got from them is $20,000. So cash debit $20,000. This money belongs to the shareholders. It's an investment by shareholders. So credit common stock. Common stock represents the ownership of the stockholders, what they've put into the business. So common stock is credit. It's an equity account. Let's move on to number 6. In number 6, we paid employee salaries for the first half of the month, $1,200. Again, this is a cost of doing business. Just like the very first transaction I told you, it was a cost of doing business. You got to pay rent. Similarly, you have to pay your employees. When you pay your employees, you debit salaries expense. Salaries expense, rent expense, they're both equity accounts, just like service revenue. Service revenue increases the equity account, expenses decrease the equity account. And I paid cash, so cash is credit. My cash balance has decreased now. and that's $1,200. That's how much I've paid up. Let's move on to number 7. In number 7, I purchased advertising on several local radio stations to be aired during the following 2 weeks, okay, which is $1,000. I paid money. So that part, the part that's easy is cash credit. We know that cash is credited. I need to figure out what I'm going to debit. Now, since the ads are going to run over the next following 2 weeks, it's going to be advertising expense. Now, if they had said it's going to be over the next 1 year, an extended period of time, then I would say it's prepaid advertising. But typically, advertising dollars, most companies, as soon as they pay, they just write it off as an expense because uh, basically they don't know when. Hopefully, they will get the benefit, but they don't know when they will get the benefit from running the advertising. So, advertising expense debit, cash credit for $1,000. Moving on to number 8. What do we have in number 8? Okay. We provide guided tours to customers in Yellowstone National Park on account, $3,200. Now, unlike the second transaction where I provided guided tours to customers for cash, there it was cash debit service revenue credit. Now this is on account. So let's see how my journal entry is going to be different. The part that's going to be the same like the previous one, service revenue credit, because I've earned the money. Now, the customer did not pay me right now. They will pay me in the future. So that money is receivable. So accounts receivable debit, service revenue credit. This is an asset, accounts receivable. Number 9. Okay. One of the customers from the December 22nd tour, that's a previous transaction we looked at, claims to have seen the legendary creature Bigfoot. The company believes this exciting news will create additional revenue of $20,000 next year. So all because we saw a customer saw, well, he or she thinks that they saw a Bigfoot. We can obviously publicize this, talk about it, all kinds of stuff, and we think it's going to give us revenues in the future, get us more revenues in the future. Well, right now, that's great news. However, for this date, okay, there is going to be no journal entry. I need to actually see customers come in and pay me. Otherwise, there's nothing here for me. A lot of publicity, but it has to turn into my revenues. Okay, for revenues to happen, customers have to come and they have to go on the guided tours. That's the only time I'm going to get I'm going to have a transaction in my books. So for now, it's just great news, but that's all it is. Number 10, on the 26th, we purchased several pieces of hiking equipment to give customers a more enjoyable adventure, such as night vision goggles, GPS, long-range binoculars, video cameras, all of this, we paid cash. It's for cash. The purchase was for cash, $28,500. So this is a real transaction. Cash has actually left us. So cash is going to be credited. I gave cash. Cash left the business. What came into the business? Equipment. So again, here I'm trading one asset for another asset. I gave up cash and I got equipment. My asset equipment increased. The balance increased by 28,500 and cash decreased by 28,500. Let's see what we have next. On the 28th, we pay cash on accounts payable. So we owed money. Accounts payable means we owed money. We are paying $1,500 to whoever that vendor is that we owed the money to. So I'll write the date. Accounts payable, the liability will decrease. Cash is also decreasing. So in this case, both accounts are decreasing. Cash is an asset, normal balance is debit. To increase it, I debit it. To decrease it, I credit it. Accounts payable is a liability, normal balance is credit. To decrease it, I debit it. To increase it, I credit it. So in this case, I'm decreasing cash and decreasing accounts payable. That liability is going off my books because I paid the cash. And finally, on December 31st, I paid dividends to stockholders. So my journal entry over here is going to be dividends debit, cash credit, cash I'm paying cash, and dividends is basically a payment to stockholders. Now, don't confuse this with your expenses. Expenses are paid to outside parties for a benefit that we received. Rent expense, salaries expense, advertising expense. It's an outside party with whom we transacted, and we paid them we have to pay. If we have not already paid for the services, we paid. It's cost of doing business. Dividends is basically a share of the profits that is being given to the owners of the business. So the dividend account is eventually close to retained earnings. You will learn that in the subsequent chapter. Okay, now that I've done this, let's move to the next step. So I've done all my journal entries. I need to post them into my ledger. So start with the first one. The first transaction, rent expense debit, cash credit 900. So you look at rent expense over here. What I will do here is, I'm going to show it to you all at one time. I write the transaction number, and that number column is for the transaction number. The date, that's December 1st. It was debited 900, so put in the debit column. Now this is important. You need to know this balance that you had, was it a debit or a credit? For all, let's go through this. For all expenses, it is debit. Let me write this down over here so we can see this. Okay. So try and remember the acronym DEAD. Okay, rather morbid, but it's going to help you. So D equals debit. Okay. E equals expenses. A equals assets. And D equals dividends. Okay, so let me, okay. Okay, so we have DEAD as the acronym that I'd like you to remember, and recall this every time you're doing your journal entries until you kind of get used to it. We are going to debit all expenses, assets, and dividends in order to increase it, which means that's their normal balance. So what's left for credit? Okay, so if I have to remember, what am I going to credit? Well, what's remaining? We have all our liabilities, all the equity accounts, and I'll go over that in a second, and revenues. Okay, so I credit liabilities, equity. In equity, we are looking at common stock and the retained earnings. Retained earnings may be debit or credit, but common stock is always credited to increase it, and revenues as well. So this is, we're looking at what's a normal balance. Okay. Now, having said that, expenses have a normal balance of debit. I debited it another 900. So what's my new balance? 9,900 plus 900 gave me 10,800. Okay, so that's one part. The second part is cash credit, 900. Again, transaction number is 1. The date is December 1st. I'm not debiting cash, I'm crediting cash. Cash normal balance is debit. I have 9,200 debit. I'm crediting cash. I'm doing the opposite. So the difference is going to be 8,300. 9,200 minus 900 is going to be 8,300. Let's look at the next one. Cash debit, service revenue credit. So cash is debited. Write the date. It's debit. So now it's 8,300 plus 2,800. And that'll give me 11,100. Service revenue, 2,800. Service revenue, again, first write the transaction number, the date, service revenue is credit. Remember, all revenues, normal balance is credit. So I have $75,000 credit. I credited another 2,800. So my new balance now is 77,800. I would do this for all the journal entries. I post everything in over here. So at this time, I've already done it. I'm just going to show you all the numbers. Okay. Now for the last step, which is preparing the trial balance, let me move over here and tell you what I need. From each of these accounts, I need the final balance. Okay, so I shall do this real quickly over here. From every account, I need the final balance. I just need the ending balance that's there in every account. So I'm just showing you some of them over here that you see on the screen. Okay. Okay, so what do we do over here? Now, if you recall over here, if you looked at our, let me scroll this down here so we can see this. If you looked at the trial balance that had been given to us, you saw the account names, how they were arranged. You list all your assets first, then your liabilities, then your equity accounts, which is common stock, retained earnings, and dividends. Then you list revenues and expenses. That's typically the order in which it's listed. Now, the the journal entries you've done, the ledger accounts that you have, based off which you have your trial balance, all of these are internal documents. You never share this with anyone outside the business. So what order I set this up in doesn't matter. It's for me internally. The financial statements, the income statement, statement of owner's equity, balance sheet, statement of cash flow, those are shared with outsiders. So at best, the only other person who's going to look at this, if I'm a company that needs to have financial statements reviewed or audited, my auditor may look at this, okay? But no one else is going to look at it, what I've done so far. But it's always a good idea to set this up in that same order: assets, liabilities, owner's equity, revenue, and then expenses. So I have copied down all of these account names as they have appeared, and I bring all my balances over. Now, what is really important is you make sure that you put it in the appropriate column, debit or credit column. So all assets are debit, normal balance. Liabilities are credit. Equity is credit. Dividends is debit. It's not credit because you're paying out from the retained earnings. You're giving dividends to the shareholders. It's leaving the firm. Revenues is credit and expenses are debit. Now, if you've done all of this correctly, our trial balance, these totals have to be equal. Total debits must be equal to total credits. That's the basic accounting rule that we have. Total debits must be equal to total credit for every single transaction. If we have done that correctly in our journal entry and done the posting correctly, these numbers have to be equal. They cannot not be equal. And if they are not equal, you made a mistake. The mistake could be you probably did not post correctly. You forgot to post, error of omission. Or it could be an error you made in terms of posting the number on the wrong side, the debit or the credit side, you flipped it around, or you made a mistake in the number that you posted. That's most likely the case. Also, if you look at it just visually over here, the account where you have a maximum number of entries is typically cash. Most of the other accounts, there are far fewer entries. So once again, cash is an area you need to look at very carefully. This is most likely where you made a mistake, which is why in a subsequent chapter, you're going to see that every company will prepare a bank reconciliation statement, basically trying to reconcile their cash account. So whatever I say I have, the bank should say I have the exact same thing. And that's a way to verify that I've done everything correctly and find if there are any mistakes. So this concludes this particular exercise in which we were asked to prepare, record in the journal, post into the ledger, and then prepare our trial balance. We also analyzed every journal transaction before putting it into the journal. So we've done the first 4 steps of the accounting cycle in this exercise.